discuss Reuters' Breaking Views predictions event of 2021, which Refinitiv is proud once again to sponsor. This is, of course, taking place with the inaugural Reuters Next Summit, which we're also very pleased to be a part of, and I'm sure it'll be a huge success. Refinitiv's relationship with Reuters goes back many years, through our time as part of Thomson Reuters and beyond. As a provider of data and intelligence to global financial markets, we're proud of our ongoing collaboration with Breaking Views in general and their annual predictions events. Energy has been a fascinating market for decades, but the urgency of climate change has ignited a debate over how much of the world's energy needs can be met by clean technology and how quickly the transition from fossil fuels may happen. Both Reuters and Refinitiv have a long history of providing transparency to participants in the energy markets across oil, natural gas, power, coal, and more recently, carbon and renewables, including hydro, wind, and solar. In 2006, British data scientist Clive Humby claimed, data is the new oil. And although there are similarities, for instance, both of them power all kinds of economic commerce, and also data, very much like crude oil, must be processed and analyzed to create value. That said, it is not the quantity of data that a company possesses that determines its competitiveness, but rather how it uses that data, whether in support of short-term trading or long-term investment decisions. Access to comprehensive, accurate, and timely data is a key goal for many of our energy clients and is especially pertinent to forecasting the mix of technologies and fuels which will service the energy needs of the future. With that in mind, I would like to turn the virtual stage over to Breaking Views' Lauren Silver Laughlin and Rob Cox for their discussion with Chevron Chief Executive Mike Wirth for what I'm sure will be a fascinating session for all of us.
Thanks very much, Dean. Hi, Mike. How are you? Thank you so much for being here with us in what is certainly going to be.
I'm happy to be here.
Very exciting conversation. Pivotal moment for your business. I'm just going to jump right in with my first question. April 20th, if I can bring you back there, early part of the pandemic, we're all sort of crouched in our corner offices, and West Texas Intermediate decides to go from $20 a barrel to zero to negative $40 a barrel. So where was Chevron CEO Mike Wirth when that happened? What were you thinking? Were you thinking, I can't believe I'm CEO of one of the largest oil companies in the world right now?
Well, it's interesting. Actually, I was sitting right here in my office at home that day, and I tend not to watch the price of oil in real time, but I have some screens I glance at through the course of the day, and oil price is one of the things on there, and it's hard not to notice when your primary commodity is plummeting the way that it did that day. The set of circumstances that were in effect at that time were really quite unprecedented. Much of the world had gone into some form of a lockdown of economic activity. Demand for transportation had really been constrained, and therefore demand for fuels. And certainly our products do more than just transportation, but we saw an unprecedented contraction in demand. And our industry is one where we have moved towards much of a just-in-time kind of a supply chain. And so the concern when you drop that much demand in such a short period of time is the supply system is set up to reliably supply energy on an ongoing basis. And we were seeing storage capacity fill up dramatically because there was no place for the production to go. And there was a concern that there would be no place to actually physically store the barrels of oil. And so we were shutting in some of our production at that point in time and watching, to Dean's comments about data, watching storage data very quickly. And of course, in the financial markets, oil is traded not as a physical commodity, but a paper commodity. But the contracts can call for the holder of the contract to take physical delivery of the oil, and nobody wanted to be caught in a position where they had that obligation and didn't have the capacity. So we saw a really unprecedented set of circumstances. The negative price was obviously an aberration, a point in time, but the trend and the fact that it could go negative really was dramatic evidence of this different set of fundamentals that existed then,
Yes.
and
Yeah.
that we've been gradually moving away from here back towards normal subsequently.
That's interesting. So, as you say, it was a sort of a technical issue at that time, but really it showed some underlying problems. Energy consumption, is projected to have fallen into 2020, oil consumption as well. So, how do you see the sort of next 6, 12, 18 months? And how do you, I'm assuming you don't think that we hit peak oil in 2020, although some people are saying that we did. But how do you get to those sort of pre-COVID demand levels? How do you see the world recovering over the next 18 months?
Sure. So I see 2021 as being a much better year than 2020. Clearly, we're not out of the woods yet on the pandemic. And in fact, right now, we're seeing some of the worst conditions since the beginning of this pandemic. But there is, I think, very legitimate reason to believe that we're headed to a better place. And, we're seasonally in what most people predicted before any expectations on vaccines, what was going to be the worst period of time. It's very analogous to what we saw 100 years ago with the Spanish flu. And so we have that phenomenon. You have people that are tired of some of the restrictions, and I think it's been harder for people to maintain the behavioral safeguards that we all have tried to communicate to people. And so I think right now it feels not much different than 2020 did. However, with the progress we've seen on vaccines, the government actions in terms of stimulus in governments around the world, 21 is shaping up to be a year of recovery. 20 was a year of dramatic contraction and response. I think 21 is the beginning of the healing process. I don't think it's the end of the healing process, but we should see economies around the world begin to move forward as the vaccine becomes, or the pandemic becomes much better controlled, and people get back to some level of activity that they've been suppressing. And so a part of that is transportation and other economic activity that drives demand for our products. And the fundamental drivers for demand, to your question on peak demand, really are largely unchanged. We've got 7.5 billion people on the planet today. By 2040, that number goes to 9 billion or more. We have an emerging middle class in much of the world that is aspiring to a higher quality of life, which means more consumption of all types of products, including energy. And while there will no doubt be, I think, some changes in markets as we go forward, some of those underlying fundamentals really haven't changed and look like they will drive demand for energy up over time, and the percentage supplied by our industry likely to remain somewhat similar to what it's been historically, with, I think, some shifts overway, but difficult in a market that continues to grow for those numbers to change as dramatically as some people would suggest.
And that sort of emerging market sort of growth story is what has driven a lot of people to still be very bullish about the oil price over the next several decades. There are changes, as you say, and we'll get to those in a little bit, but just sort of taking that as a fact and as a given, let's say, that perhaps, oil dependence isn't going away. You still have to fund that. And you're in an environment right now where shareholders are attacking your business. Exxon, clearly your biggest rival in the US, has, an activist shareholder. What does your shareholder roster look like in 5 years? I was talking to someone yesterday who suggested that Chevron and its peers would have to go private because it wouldn't be able to find public investors to fund the business. This is the kind of criticism that you're sort of under, this scrutiny you're under right now. Who's going to be your investor? Yeah.
I think our investors will be many of the same institutions that we see today. They are looking for returns for their shareholders, and that's a primary intent. And look, our industry has not delivered strong shareholder returns over the last decade. And the single largest criticism of the energy sector is that it has destroyed shareholder value by not being good stewards of capital. This is an industry that's a mature industry, it's a low growth industry, and yet it has overinvested for growth over the last decade. And that has created an excess of supply beyond demand, and it has depressed the financial performance of the sector. And look, we've been in a period of time in which money has been free, right? There's been no shortage of access to either equity or debt for companies that are looking to grow. Many of them not looking to sustain long-term value, but looking to grow and sell. And so this has been fueled over the last decade, and it's been, I think, the single biggest shortcoming of the sector that I work in. And our company is not, without its own, I think, shortcomings in that area. We have tried to change that and be much more disciplined in our approach to capital investment, much more focused on value and delivering shareholder returns. Some of our competitors had to cut their dividends, some to zero, some dramatically, and most of our shareholders look to us for a reliable source of income. So there are four words I use to describe the imperatives to our people. It's higher returns and lower carbon. And we need to do both of those. And that's what shareholders are looking for, is for us to deliver stronger returns. So they're assured that we have the ability to ride through these commodity markets and they can rely on that dividend. And then they also expect our industry to be part of a lower carbon future. And certainly that's what our company is committed to. That's what our shareholders engage me on. And I think as long as we're diligently pursuing that and delivering strong progress towards both of those ends, we will continue to see shareholder support and investment.
Well, we'll get to lower carbon in a minute, but the higher returns is a good point. So we're just talking about relative returns. Chevron has been very strong compared to its peers on returns, which has put you in this position to be an acquirer. We saw that you bought Noble. You had this very shrewd decision to walk away from Occidental back in 2019. If there's attrition in the industry, does Chevron become the sort of lone man standing? What is your acquisition strategy, now, especially given where oil prices are?
Well, we're always looking. It's a resource industry. You deplete your current resource base, and so you're always looking to add. And we can add resources really three ways. We can go out and explore and find new undiscovered resource. We can use technology to improve our ability to recover resources that we have, but we didn't know how to produce. Or you can go out and acquire, discovered resource or or acquire companies that have a resource base. So we're always looking at all three of those. We're very selective. We wouldn't do a deal just to do a deal. We look for things that will make our company stronger, that will strengthen our portfolio and compete for capital. I mentioned capital discipline earlier. We are in a commodity business. Costs always matter and capital discipline always matters. And so we have to be selective in where we invest. And it wouldn't make sense to acquire a company just because they're available if their assets don't compete for capital when we stack them alongside the opportunities that we already have. So I think the industry is likely to see further consolidation. We've got too many, particularly in the U.S., probably more companies than is logical to develop the resource that we see. There's too much overhead and cost in the industry. And so I think you will see some further consolidation. Whether or not we're one of the participants in that would depend on the specific circumstances.
But it sounds like the U.S. is a focus there. I mean, when you're looking across the sort of globe, there are quite a few players still in the U.S.
Well, certainly, we've got a large U.S. position right now. We don't necessarily need to be bigger in the U.S. I'd always like to be better wherever we are. But I think that the U.S. Has a long history of lots of startup, entrepreneurial, E&P companies that have a long legacy in this industry, and there's certainly a number of those that we've seen over the last decade, and we've seen some consolidation over the last 6 months or so, and I think the future probably holds more of that. When and where, still to be determined.
Well, your position within the U.S. is fascinating. I think now with the transfer of the administration, I'm going to kick it over to my colleague Rob, I think, who wants to drill down a little bit more there. Of course, you'll probably have some more pushback from, I would suspect, the Biden administration than that you had with the Trump administration.
Well, yeah, I want to pick up on that, Lauren. I mean, Mike, Donald Trump loved fossil fuels. He made that very clear. He loved coal. He loved hydrocarbons, all of it. Joe Biden hasn't said he doesn't like fossil fuels, but he has certainly been much more, he said a lot more things about things like the Green New Deal. I'd just love to get your sense of what you're expecting from the Biden administration. And I'd say sort of in three areas. I mean, one is just plain regulation. So, how will that change under this new administration? You see Gina McCarthy is now, I think, the domestic climate czar. You've got Jennifer Granholm as the energy minister, energy secretary. It's a different cast of characters for sure. And then sort of, we'll go into this in a second, but I'd love to get your view on antitrust. I mean, it's a little bit following up on what Lauren was just asking you about. And then finally, we'll get to geopolitics. But what are you thinking in terms of regulation from the Biden administration of the oil industry?
Well, I'll start with the fact that our company's been around for over 140 years. We have worked with administrations from both sides of the aisle with different points of view on a whole host of issues, and successfully so over that period of time. And we try to start at a point of common ground. And no matter what party a president and their administration represents, they want to see jobs for American workers. They want to see a strong economy, and they want to see investments that support that into the future. And so that's the starting point. Whether we're talking a Democrat or a Republican administration is what's our role in that economy, and how can we support that agenda? And I think there's surprisingly there is much more common ground than people might expect. You get down a level or two into regulatory policy, and there can be different points of view, no doubt. We try to bring facts to the table. We try to talk about cost-effective, prudent regulation that protects the environment, that protects worker safety, whatever the particular issue may be. Our industry has technical experts and operating expertise that is incredibly deep, and we try to bring those people to the table to work with the staffs and engage in discussions to advocate for good, sound, cost-effective regulation. Our company is headquartered in California, which in recent times hasn't seen much of a switch of parties in administration. It's more of a one-party state, or has been for the last couple of decades. And we've very successfully worked with the Air Resources Board and other agencies here in just that manner to advocate for good, sound regulation that we can support, that we think is good for the economy, good for jobs, and allows our industry to contribute. And so that's what we'll do with the Biden administration. There's some new faces. We have to get to know people, but some people like Gina McCarthy certainly was at EPA before. We've had interactions with her for a long time.
And are you expecting?
I expect us to be engaged constructively and find common ground.
And what about, you expect that the Biden administration will bring the United States back into the Paris Climate Treaty? Does that have any impact on the way you look at the world or your business?
No, it really doesn't. We support the Paris Agreement. We support the aspirations for a lower carbon society, and we're working in that direction. And so I don't think that has any fundamental changes in terms of its impact on our company.
And then just on antitrust and competition, just thinking a little bit about the M&A question that Lauren asked. Go back to your history. You were part of Standard Oil, of course, which was effectively viewed as a monopoly by the government and broken up into many different businesses. Are we not in a position where, when you look around the world and you think about national oil companies and the transition towards other forms of energy, are we not going to come back to some sort of almost mega U.S. oil company in the next few years that looks like a Saudi Aramco? And where would Chevron be in that mix?
Well, it's interesting. Most countries do have what you would describe as a national champion, and the U.S. is a little bit different in that it's had a large number of companies, and it was blessed with abundant resources and a legal and capital system over the last 100+ years that has allowed companies to start up and to compete and to thrive, not only in this country, but then as global competitors as well. And so the U.S. industry is a little bit different. These things go through, phases, and certainly, we've got a view that commodity prices are likely to be somewhat lower for longer. Certainly, not the $100 prices that we saw, a decade ago. And that requires scale, it requires efficiency, it requires discipline. And oftentimes those things go with consolidations. And so, that's the basis for my earlier comments that we could expect to see some consolidation. Whether or not you would see, mega, companies come out of this, I think is, I'm not going to speculate on that. That's
the Exxon Chevron recreation of Standard Oil, not quite on the. We're not expecting that anytime soon.
Yeah, those are kind of incendiary things to speculate about, and I'm not going to go there.
And then I guess just geopolitics a bit. So thinking about a new approach to the world under the Biden administration. Some places where you operate. Think of Saudi Arabia, for instance. The Trump administration, Donald Trump's first visit as a foreign visit was to Riyadh. I suspect we'll see a different approach to Saudi under the new administration. But and then likewise with Russia, some of the other large petroleum economies around the world. How are you viewing the world map under Biden administration? And then sort of corollary to that is, does it change in any way the way you allocate capital around the world?
This is part and parcel of my earlier comments that, the geopolitical dynamics in this country or in other countries and the intersection of those between countries is something we've been dealing with for a long time. We've been in the Kingdom of Saudi Arabia since the 1930s, and the longest history there of any company that there is. In fact, we founded Aramco.
1939 or something. You were the
1936. We made the first discovery there, and so we've got a long history here. I think certainly the Trump administration was more inclined to use sanctions and kind of more muscular trade tools than some of the prior administrations that we've seen. Had a different view on Iran in the Iran agreement that came from the Obama administration. Was aggressive in terms of sanctions against Venezuela, for instance, which is a country where we still have a presence. And so all of those things, we've had to deal with the Trump administration, and we'll be dealing with the Biden administration to help inform their policy making. And look, American governments typically want to see American companies be successful, and they want to see American companies help build relationships amongst nations, and that trade and commerce and investment can do that. And so we'll work to be sure that they understand our perspective and knowledge from operating in these locations, and then understand what their agenda is and how that intersects with our business. So that's part of the normal risk management and policy dialogue that's part of our business.
I guess just one last question, political question, if you will, which is, call it a risk question. We saw last week changed, I think, for a lot of people, potentially their view of America's, the risk in America, as it were, domestic risk. A lot of companies have suspended their political donations, PACs and things like that. Visa just did it, one of your neighbors up there. Where Chevron has, like most oil companies, has largely donated to Republican candidates, or its people have. What is your plan? Are you going to suspend PAC donations for any period of time? Have you taken a position on this yet?
Well, first of all, we do donate to both parties. I think in this last cycle, it was about 1/3 to the Democrats and 2/3 to the Republicans. So we support candidates that we believe take good principled positions. They're good for the economy, good for jobs, good for energy investment in the energy industry. But they exist on both sides of the aisle. And we regularly review our policies and procedures for political activities, including contributions. I've specifically asked my team to take a look at the events of the last week and make sure those are brought into account as we make our decisions going forward. So that'll be part and parcel of our decision making, and those reviews are underway.
Okay, I'll pass it to you, Lauren.
No, thank you. Appreciate it. I want to be sure that we ask our sort of climate questions here before we go to our questions from the audience, because we actually have quite a few of those as well. So BP plans to cut its oil production by 40% by 2030, I believe. And of course, many of the European oil companies have already adopted Scope 2 and 3 emissions targets. You have been committed to fossil fuels and remain committed to fossil fuels, very much like Exxon. But you have talked a little bit about carbon, acknowledging that it's an issue for the industry. What exactly is Chevron doing? When you sit down, say, with Larry Fink, and he says, I'm getting pressure from my own investors to hear from you, what do you tell him about how you're dealing with carbon and climate?
Well, first of all, I tell them we support the Paris Agreement. And we believe the energy system is moving to a lower carbon energy system over time, and we intend to be a part of that, and we intend to be successful in that. Three primary areas that we're working on. Number one is reducing the carbon intensity of our current business. The world uses a lot of oil and gas today, and it can't transition off of oil and gas overnight. And so we should work to reduce the carbon intensity of today's energy system. And we've got very specific targets to do that. They're tied to compensation for myself and virtually every employee in our company. And so that's a big thing, is to reduce the carbon intensity of what we're using today. The second is to integrate renewables and offsets into our business in a way that further reduces the carbon impact of energy. And we're doing this with wind and solar that's replacing fossil powered generation. We're producing renewable natural gas right now by capturing methane from dairy farms and processing that to displace fossil natural gas. We're providing renewable diesel and investing in more manufacturing of renewable diesel, renewable base oil. So renewable products, offsets, and ways to reduce the carbon footprint of our products. And then the third is to invest in technologies to enable commercial and scalable new contributions to the energy system. And these are things like carbon capture and storage, which any credible study, including the IPCC, recognizes that we're going to have to find a way to remove carbon from the system to achieve these goals. These are the kinds of things that companies in our industry currently do and can find ways to do bigger and more economically. Things like hydrogen, geothermal. So we're investing, particularly through our venture capital arm, which we've had for 20 years, in startups that have interesting, new, novel technologies and ideas for ways to create these low or no carbon energy systems into the future. And so we're working across the spectrum of things. We're engaged with our shareholders, including BlackRock, to understand what they think, and fully committed to, as I said earlier, higher returns and lower carbon.
And
let me ask one quick question from the audience, and then I'm going to hand it over to Lauren. This has to be quick, Mike. What are some really promising technologies that you're watching as a big threat to oil?
Well, a big threat to oil is, to be honest, and this is going to sound like I'm talking my own book, so I don't want it to sound that way, but a big threat to oil is still fairly hard to find. There are things that are moving oil demand out. So electric vehicles, which everybody's very familiar with, and we're seeing a lot of investment in, a lot of excitement about, hold the prospect to change light-duty transportation. And we're beginning to see that now. It's still very early when you get down to the actual numbers of EVs in the fleet, but we expect hundreds of millions of EVs by 2040 in our base case. And that shifts demand for light-duty transportation fuels. There's other sectors that are much harder to decarbonize. Heavy-duty transportation, so long-haul road transit, industrial uses, shipping, aviation, petrochemicals, where 3/4 of the demand for a barrel of oil goes into these sectors, not into light-duty transport. These are much more difficult to get after. If you listen to Bill Gates talk about it, and it's very hard. Hydrogen is one of the ones that holds a lot of opportunity here. Frankly, nuclear is not a popular technology to talk about with a lot of people, but nuclear holds the prospect to be an important part of that system as we move into the future as well. So those are two that I would highlight, along with carbon capture and storage, which allows us to reduce the impact of things that we can't otherwise find ways to displace.
I think that's all we have time for, unfortunately. Mike, this has been very illuminating. Sorry for the cliche, but we really appreciate you giving us your time. Thank you.
Thanks,
Lauren,
Mike.
Rob, thank you.